Hello traders, welcome back to LiL Forex Academy, where we learn, trade and earn. In this video, we are going to answer a very important question many traders ask. Who are the Forex market makers? You might have heard traders say something like, the market makers hunted my stop loss, smart money moved the market, most especially if you trade with SMC. But who are these market makers and how do they influence the Forex market? Today, we'll break it down in simple and practical way. First, let's talk about what are market makers. Market makers are large financial institutions that provide liquidity to the forex market. These institutions include major banks, investment banks, hedge funds, liquidity provider, and large financial institutions. Example, just think about JP Morgan, Goldman Sachs, Citibank, and many others. This institution trades billions of dollars every single day. Their job is to ensure there are always buyers and sellers in the market. Without market makers, the forex market will not have enough liquidity for traders like you and me. So when you place a trade, there is often a large institution on the other side of that trade who is doing the opposite of what you are doing. Now, let's talk about why market makers move price. Market makers move price because they handle large orders, a very large orders. So if a bank wants to buy $500 million worth of Euro USD, they cannot execute that order at a single price. There must be enough sellers in the market to fill that order. So what happens? They push price into area where liquidity exists. And where is liquidity usually found? Liquidity is usually found around stop losses, support levels, resistance levels, trend line breaks, and retail traders entries. This is why sometimes you see price spike above resistance, take out stop losses, and then reverse strongly. This is often called liquidity grab. Now, let's talk about how market makers hunt liquidity. So, market makers are not necessarily hunting you personally. What they are hunting is liquidity. Retail traders tend to place stop losses in similar areas. For example, many traders place stop losses below support, above resistance, above previous highs, below previous lows. Because of this area contain large pool of liquidity. So market makers sometimes push price into this zone to trigger those stop loss, which creates the liquidity needed to execute large orders. After the liquidity is collected, the market often moves in the real direction. This is why many traders feel like the market took my stop loss and then went exactly where I predicted. Now, let's talk about how smart traders think. Instead of trading like the crowd, smart traders try to understand where liquidity is sitting. They look for liquidity zone, stop loss clusters, fake breakout, and market structure shift. Instead of entering the market where everyone else enters, they wait for liquidity sweeps. So this concept is often called the smart money trading. The goal is to trade with the institutions and not against them. Understanding market maker can completely change how you see the market. Instead of asking where should I enter, you start asking where is the liquidity. You begin to understand why stop losses get triggered, why breakouts sometimes fail, why price move aggressively after liquidity grab. This knowledge helps you to avoid common retail trading mistakes. If you find this video helpful, make sure you subscribe to LiL Forex Academy. I create content to help traders understand the market structure, trade smarter, and improve their strategy. Also, let me know in the comment section, do you think the market maker manipulates the market or are they simply providing liquidity? And in the next video, we will discuss how smart money manipulates liquidity in the forex market. Until then, learn, trade, and earn. Bye.